Are you tired of making millions in revenue on Amazon, but looking at your bank account and wondering why you don't have any money left in the bank? This isn't just about making money online. It's about creating a financial strategy that could set you up for life. And today's guest knows exactly how. Welcome to the Ecomm Breakthrough Podcast. I'm your host, Josh Hadley. I scaled my own brand from 0 to 8 figures in sales, and now my mission is to take it to 9 figures. On my journey to 9 figures, I bring you unfiltered conversations with the smartest minds in e-commerce. Past guests include Kevin King, Michael E. Gerber, author of The E-Myth, and Brandon Young from Seller Systems. Today's guest brings a rare combination of deep financial expertise, entrepreneurial insight, and a proven track record of helping high-growth businesses scale and stay wealthy at the same time. I'm thrilled to welcome Bryce Keffeler, a managing partner at Do Wealth Management, a firm that has not only been named a great place to work, but has also made the Inc. 5000 list for 4 years in a row. Bryce specializes in helping business owners grow, manage, and protect their wealth using family office level strategies. Think M&A and investment consulting and financial structures designed for 10x growth. Before Do Wealth, he worked in corporate M&A at Intel and has since become a serial problem solver for founders navigating complex exits or aggressive scaling. Welcome to the show, Bryce.
Thank you. Thanks for having me, Josh. I'm excited to be here. And as I said, that's the best introduction I've ever had, so I feel good.
Well, hey, it's a pleasure to have you on the show, Bryce. You and I have worked together for, I think this is going on like 6+ years at this point. We met at a previous mastermind war room back in the day. And to me, this has been something that I've just kind of like nerded out on for the longest while, which is this. I want to pay as little taxes as I possibly can. I want to keep more money in my own bank account. And I also want to be able to set up my future children and just my posterity for future success and wealth. And I think like being able to structure that appropriately starts at as early on as it possibly can. And I think that anybody that knows anything about financial investing, the earlier you start, the better things are able to compound over time. And so even when we got started working, we weren't even making what we're making now, but like it got us the fundamentals and the foundation that we needed to today. So in full transparency, everybody knows I've been working with Bryce for the last little while. And truly, it's been like game changing enough so much that it's not sponsored by them. But I wanted to bring him onto the show to share with you guys like what has been found like really game changing for our business, foundational, and it actually allows us to be more competitive in the marketplace because of the financial structures and systems that we have sitting behind us so that we don't have to take out loans for our business. We're able to not worry about like, hey, the only way that we actually make money is if we have this big exit someday. Like, because we have very smart ways where the money's flowing that allows us to build wealth, whether or not there is a big exit that comes in the future. So Bryce, I know you're going to be talking to all these e-commerce entrepreneurs. You've been working with a couple e-commerce brands right now and you have them as clients. What are some of the bigger pain points and challenges that you are seeing in that e-commerce space and anybody that's trying to exit right now?
Yeah, I think first and foremost, there, like you mentioned, the cash cycle is very difficult in an e-commerce business. I run a service-based business. It's a lot easier to run than anyone who's dealing with inventory. So I respect any type of business and entrepreneur who's got inventory because of how brutal it is on a cash conversion cycle. And so really, when I take a few steps back, I think really starting with the iOS 14 update, a lot of our e-commerce clients were really doing hyper-targeted ads through the Meta platforms and through iOS. And obviously, once that iOS change happened several years ago, we really saw a deterioration of return on ad spend. And so we saw a lot of clients really trying to push their revenue growth higher by purchasing ads, but they were actually the LTV was less than their customer acquisition cost. So they were actually underwater and they were eroding their margin structure. So we've seen a steady stair step down over the last several years of margin structure for most e-com businesses. Part of that due to the acquisition costs going up, but part of it also going to just margins being compressed and more competition overseas, tariffs, there's all these different variables. And so I think that when I think through what the biggest challenges are in these businesses, a lot of them have had to figure out how to remarket themselves in this new competitive landscape or redesign their supply chains in order to get their margin structure back to where it was to be healthy, so they don't fall into that cash crunch cycle that you mentioned. So kind of tying it all back to that. And so I think those are some of the big issues we've seen. I think some entrepreneurs have navigated that better than others, but those are some of the headwinds that I've been seeing just across our client base for those that are in the e-com space.
Yeah, I love that. And I love that you get to approach business at a totally different level. You have clients in service-based businesses, you have clients that are in e-commerce and other industries. So I think what's going to be unique about our conversation is like you're able to apply other principles and things that are working in maybe a service-based business that you could apply into an e-commerce-based brand. Bryce, with all of that being said, are you recommending your clients like, hey, if I'm you, I get out of e-commerce. Like these headwinds are like, these are too much. What are your recommendations to your clients that are in e-commerce right now? And what are the strategies you see them employing in order to stay afloat and to still be like gain market share?
Yeah, I mean, I definitely would not tell any entrepreneur to get out of the space that they've, built a very successful business in. And all of our clients are at the stage where they're very successful, 7, 8, 9 figures, entrepreneurs. But I think one of the big coaching, I would say, is really pushing the entrepreneurs to come up with a model P&L. And what I mean by that is, what percentage of revenue are we going to pay for cost of goods sold? What percentage are we going to pay for SG&A, sales, general and administrative costs? What is our target profit margin? And what's like acceptable there? And then let's use that as a framework to then make business decisions, to make reinvestment decisions. And if we're not able to hit our model P&L, then what can we do to change our supply, our supply chain? Or maybe can we look overseas to reduce our overhead costs or some of our labor costs? And that's the same approach that I use for within our business here, that I have a model P&L. And so as we look to grow, we're only going to grow within the model P&L because I don't want to chase growth that may not come and then jeopardize my profit margins, because I think that puts you just at a high degree of risk. And so I think the most successful entrepreneurs have analyzed and determined what their model P&L is, and then they made strategic business decisions that allow them to grow within that framework. And so giving you a specific example, there's one client that I'm thinking of right now that their digital marketing and really client acquisition spend was 15 to 25% of revenue, which, I mean, we've seen some clients that spend 40 to 50%, in terms of client acquisition costs. But once they took a step back, they realized that they were acquiring clients and customers unprofitably, meaning they were buying new revenue, but their profit margin was actually going down. And as we tie this into exit planning, the market no longer values you based off of a revenue multiple. They're going to value you based off of an EBITDA or a profit multiple. So this client actually pulled back their marketing and advertising spending as a percentage of revenue. They started investing in more organic and kind of grassroots marketing campaigns. And a lot of that 10 to 15% fell to the bottom line. And so the profit margins went from low mid-single digits up to 15, 20%. And yes, revenue has slowed from high teens down to high single digits, but now they're actually way more profitable as a business. So that means the owners are making way more money, way more profit, right? It's all about what we keep, not what we make. And on top of that, the value of the business is substantially higher too, because again, your valuation is driven from profit and EBITDA, not from revenue. So that's just kind of an actual case study of someone digging in is, hey, what can I do? My cost of goods sold are going up. What if I pull back my marketing spend, change my model P&L, and then I can actually make more profit, which then again creates more wealth. So that's a quick example and some frameworks I've seen, again, not just in the e-com world, but as you said, pulling from service-based businesses and even my business and what we're doing here.
Yeah, Bryce, I think that is so important. And to all of the listeners, if you are not looking at your P&L on a monthly basis and actually, as Bryce talked about, being able to like model things out, if you don't know what like your contribution margins are, right? Like you need to have, hey, how much should I budget for my cost of goods sold, right? Is it 10, 15, is it 20%, right? And then what are you budgeting for your fulfillment costs, right? So how much are you budgeting for Amazon transactions with their 15% commission plus all the FBA fees? What does that percentage need to be at? And then last but not least, well, I guess there's two other things. Number one, what's your marketing spend. So for those in the Amazon space, tacos, right? Total advertising cost to spend. What's your tacos percentage? And then finally, your SG&A. So any of your overhead, that's your salary, that's your team's salary, that's your software expenses, etc. What it takes to just run the business day to day. And then you have finally like your net profit margin numbers, right? There's like really like 5 numbers that you're trying to model off of. And these should just be like percentage targets. And as soon as you start going above or below, you can start asking yourself the right questions. But I love that you talked about like, first have a model P&L that you're like, in an ideal state, this is where we're at. And so when you look at your numbers on a monthly basis, if you're above or below, it then drives the next business decisions that you're making. But I'm a big proponent of like the actual planning is where the magic happens. Because if you're just looking retroactively at your P&L statements, like that stuff's in the past, right? But it's in that planning stage that happens 12 to 18 months beforehand that actually ends up with the results that you're looking at in your current P&Ls right now. So Bryce, love that. Now, you mentioned earlier that you're helping some e-commerce clients like actually go through the exit process right now. So what are you seeing from your side of if you're planning for an exit, here's some things you should be considering to protect your wealth. What does it look like in terms of multiples? Kind of give an overall synopsis that way.
Yeah. So I will say, I'll caveat, there's a huge range of outcomes, and a big determinant of what I'm about to say is based off of your revenue, your profit, right? That's obviously going to drastically change kind of my answers. But just to give you context, this e-commerce client I'm going to be talking about here is going to be doing well into the 8 figures of revenue here and mid-single digits in terms of profit, of millions of dollars of profits, right? And so within the context here, we talked to over 15 bankers and investment bankers. And an investment banker is going to be the professional who's going to help market your business to then sell your business to a private equity company, a strategic buyer, or someone else. And so they get paid a commission based off of which is generally a percentage of the total value of the business that they sell. So think of it like a real estate agent, but for your business. And when we interviewed all of these different bankers, I heard profoundly, when I asked one of the bankers, what is the optimal kind of demographic or the demographic, I guess, really look like for a business? And he told me $100 million of revenue, $20 million of EBITDA, and has 1/3 distribution through Amazon, 1/3 distribution through your Shopify account, 1/3 distribution through retail. So he said that is the nirvana state. Now, the nirvana state doesn't exist, right? But you have, at that size, you have the size and the scale of a 9-figure revenue business doing 20% profit margins, and you're diversified across Amazon, Shopify, and retail as your distribution mechanisms. So you're insulated. So although that's probably not you, anyone listening to this definitely wasn't the client that we're talking about here that I'm thinking of, but I think there's some things that can be taken from that, okay, first and foremost, size matters. The larger your revenue and the higher your profit, the more valuable you're going to be. And a lot of these businesses trade based off of profit multiples. And so I think that if you're in like the 6-figure range to low 7-figure range and you're highly dependent on Amazon, a lot of the multiple feedback we got is you're maybe 3, 4, 5x in terms of profit is your valuation. Now, for this client doing several $1 million of EBITDA, we're looking closer to 8 to 10 times. Again, 8 to 10 times that profit number as the valuation. And those multiples can get up closer to 12 to 15 if, again, your profit is closer to that $20 million mark. You have 20% profit margins, and again, you have wide distribution. So that's kind of the lay of the landscape. And as we interviewed 50 different bankers before hiring the one that we're going to go work with, it was pretty common that that's kind of what we're seeing. So again, big variables, size matters. Focus on profitability, not on revenue. You want to get 15, ideally 20% profit margins. 25% is kind of best in class. And then you want to try to diversify your distribution channels. If you're wholly dependent on Amazon, since everyone, Josh, and everyone listening to this, it is such a tough business and you have so much competition overseas. The multiples have really compressed on Amazon-driven businesses.
Yeah. Do you see, is there kind of like a magic point of if you cross 5 million in EBITDA, I think that's where like private equity gets involved, right? Like, is that still true? Like 5
Yep.
million in
Yep.
EBITDA?
Exactly. And that's why this client had just crossed the $5 million EBITDA threshold. And so that opens up a lot more demand. And the reason why is private equity, who's one of the main buyers in this space, if they buy a company that's doing $100 million of profit or $2 million of profit, it's the same amount of work. They have to do the same amount of due diligence, reviewing your financial statements, all of your agreements, et cetera. And that costs them hundreds of thousands, if not millions of dollars in due diligence from attorneys, from bankers, from CPAs and accountants. And so they want to make sure they're buying a company big enough that they can honestly just amortize their cost over time over that transaction. So that's why the $5 million threshold is kind of the first magic threshold where all of a sudden a lot more private equity companies will be interested, because sub 5 million, it's oftentimes just too small for them to even look underneath the hood. So you're spot on, Josh, that 5 million is the first big target you want to hit. And then kind of 10 million tends to be like the next big threshold that again, you get a nice little step up in valuation.